Hello, and you're very welcome to this May 2019 operational case study series of videos where we'll be looking at each section of the pre-seen document for May 2019, talking about the main issues as they come up, likely exam scenarios, and reflecting on the theories that relate to the information contained in this document from your E1, P1 and F1 studies. So the company in question for this particular pre-seen is one by the name of VitaMine. And VitaMine, as we will see shortly, is involved in the manufacture of vitamins and supplements. This is a market that is clearly enjoying a lot of growth, particularly in Asia, which is the home continent for VitaMine. And throughout this pre-seen, what we'll do is we'll take each section and go through it slowly, talking about the potential exam issues and the relevance of the information contained in each section. So we'll start by taking a look at your role within the company as a finance officer and the kinds of tasks that you're responsible for. Then we'll go on to discuss the company background. We'll look at the history of VitaMine, how long it's been around, who the owners are, the kinds of products that they sell, before considering the operations, where we will look at in a step-by-step fashion the manufacturing process for the business, before considering some of the administrative functions of the business, such as marketing and sales and finance itself. Then we're going to consider the wider industry, the vitamins, minerals and supplements industry, and talk about some of the key trends playing out in recent years and the future outlook of this industry. Then we'll be considering the financial statements of VitaMine, looking at the profit and loss first of all, before considering the balance sheet, the position of the company, before then finalizing our discussion with a talk of cash flows and some financial ratios. Then we'll be looking at some budget information related to 2019. In our penultimate video, we'll take a look at the two articles at the end of this pre-seen document. And what we'll do in our final video then is sum things up, talking about some of the most important issues that we've seen, condensing the most important discussion points into a document that we will go through at the end of this series of videos. So, first things first, let's discuss your role as a finance officer at VitaMine. So you're quite low down in the food chain. You're reporting into the finance manager, Ashok Kumar, and that's someone you're likely to be dealing with quite a lot on the day of the exam. So it's quite likely that you'll be receiving requests from Ashok Kumar in the form of emails. He'll come to you with certain tasks that he will set, and you'll have to respond to those tasks. So your tasks include, first of all, the preparation of the annual budget, and there is a section of this pre-seen which we'll look at later on that outlines the budget for 2019, so it's quite likely that you might get questions on the day of the exam around variances between actuals and those budgeted figures, so it's important you have a good handle on the figures that are presented in the budget later in this pre-seen. So that's one of your tasks. Another task is to produce monthly management accounts. Also, you need to provide information to management when it's required, so that's quite open-ended because they don't specify whether the managers in question would come from your own area, i.e. finance, or whether they might come from another functional area of the business, such as the production area or the human resource area, or one of those other functions. And that is important because this really opens the door to anything coming up on the day of the exam. You should expect anything, so you could be asked to answer a question related to financial reporting or something that's related to management accounting as they relate to the budget figures, for example, or indeed something outside of pure finance and pure management accounting, going into the areas of HR, marketing, which you would have covered in your E1 studies. And finally, you're told that you assist with the preparation of financial statements, and you're expected to answer queries relating to financial reporting. And that makes a thorough analysis of the financial statements, which we'll see later, very important as well. So it's particularly important in the case study to get a very good handle on any figures that are presented in the pre-seen document. And you don't have to worry about that because we'll be going through the figures in this document in great detail. It's important to point out that in the case study exam for the operational level, technical skills play a very important role. They account for 64% of all marks that are rewarded. You might recall that there are 4 competencies that are tested at the case study exam: technical skills, business skills, people skills, and leadership skills. And what you find is that as you move up through the levels, technical skills become less prominent, and people and leadership skills, those softer skills, become a little bit more important as you get to management and strategic level. But as we're still at the operational level, technical skills account for most of the marks. Now, one concern that students often have when I bring this issue up about technical skills, they come and they ask about the necessity to produce intricate calculations, etc. on the day of the exam. Will it be deeply theoretical? No. This is an exam that tests your ability to apply your know-how in a practical fashion. The idea is with the case study exam, you're presented with real-life work scenarios, the kind of issues that might come up in your own business, and you're expected to demonstrate commercial know-how. Yes, you're expected to offer recommendations that are technically sound, but you're not going to be discussing theory in a dry fashion or producing intricate calculations. Rather, what's more typical is that you would be given, for example, an extract from a financial statement, and you'll be asked to comment on the figures, whether they make sense, whether you can spot any errors, or offer guidance to a non-financial manager, for example, on interpreting those financial statements or set of management accounting figures. So rather, it's commentary on figures that you would likely to demonstrate your technical skills in that way. So a highly practical exam, not dry and theoretical in any way. And as a finance officer, it's important to point out, first of all, that you assist decision makers. You yourself are not the person who is taking big strategic decisions for the long-term success of VitaMine. Rather, you have decision makers coming to you, finance managers, senior people at the organization, and they are asking you to comment on different problems that they face, and you have to offer some recommendations and guide them. As a finance officer, your focus is going to be very much on the short term. So you're not looking at big strategic issues, as I said, which would cover a 3 to 5 year time period, perhaps. It's all about the short term execution of day-to-day activities. So you're talking about recommendations that play out over the next 3 to 6 months, perhaps. Costing and budgets, variance analysis, all from your P1 studies are going to play a vital role. Those are topics that get covered again and again, and we will discuss those areas as we move through the pre-scene. And as I highlight issues related to those areas, we'll talk about them. Working capital management and cash management are going to be important too. So considering the receivable days figures, the inventory days, payable days, for example, seeing how the company is doing on that front, and assessing risk over the short term, again, a 3 to 6 month time horizon. But this is a very open-ended exam. You can expect to be asked anything, as I said, and you should brush up on theory from all 3 objective test areas. In other words, F1, P1, and E1. Let's take a look at the company background. So VitaMine, importantly, is fast growing. They're a manufacturer of vitamins, minerals, and supplements. And their home country is fictional, the country of Eastland. and they're based in Asia, more specifically Southeast Asia. At the end of this introductory paragraph, we're told that the currency of Eastland is also fictional, the e-dollar. So let's just reflect on this very short introductory paragraph. The fact that this company is based in Southeast Asia. Well, we know that it's a fictional country, Eastland obviously, but the territory is not fictional, Southeast Asia. So we're talking about, in real life, a group of countries made up of Cambodia, Indonesia, Malaysia, Singapore, Thailand, Philippines. So there is a great variety really in the conditions of each of these countries, and the range of per capita incomes, for example, is very wide-ranging, running from $1,264 to $57,713 in 2017. So that's a huge variation. You would suspect that the upper end there is occupied by a country like Singapore, which is very economically advanced. The lower end would be occupied by countries like Cambodia, which are still very much developing economically. So Eastland, we're not really told very much about this country throughout the pre-scene, other than the fact that there is a little bit of reference later on to the consumers in Eastland consuming quite a lot of multivitamins and vitamins, the type of products sold by VitaMine. So we might suspect that purchasing power is a little bit stronger in this country because the rates of consumption for these vitamins and minerals is in line with advanced markets like the United States. So we might suspect that Eastland is closer to Singapore than it is to a country like Cambodia, for example. But that really is just an educated guess. It's impossible to say exactly. So thinking about the Southeast Asia region a little bit more, this is a region with 8.5% of the global total population, 641 million people residing in this region, and it accounts for 3.4% of world GDP. So you might say that when you consider all of the countries as one group, that they're a little bit of an economic laggard. The fact that they have 8.5% of the global population but only contribute 3.4% to world GDP means that they lag behind a little bit. And that has implications for a company like VitaMine, depending on where they're based, as I said. First of all, staff costs, for example, if they're based in if Eastland is more akin to Singapore, their staff costs would be very high. But if they're closer to Thailand or Cambodia, it's likely that their salary costs, for example, would be much, much lower. As well, it very much influences the affluence of the consumer group that they're selling to in Eastland. And as I said, there are hints that this market is quite developed, the Eastland market, given the fact that the consumers in Eastland are consuming vitamins and minerals in line with developed markets like the United States. Okay, the fact that they operate with the e-dollar, that would affect exports. So if this is a business that is exporting a lot to other countries, then the fluctuation in exchange rates between the e-dollar and the euro or the dollar, for example, would affect the demand for their products. So this company, we're told, was founded in 2002 by the existing 4 directors, and those directors are managers. They hold equal shares, so 25% of the shares for each of the founders, who we will look at in more detail on the next page. And what this means is that it's significant from the point of view of a problem you may have been exposed to during your objective studies, the agency problem. And this is when there is a mismatch between the interests of the owners of a business, in other words, the shareholders, and the interests of the people who run the business on a day-to-day basis. So they are the senior managers of the business. So what would often happen with the agency problem is that the People running the business on a day-to-day basis would act in their own interests and pursue, for example, short-term growth at all costs. If, for example, their remuneration was tied to profitability in the short term or a rise in the share price in the short term. But what might happen is over the long term, they're actually not operating in the interests of the long-term prospects of their company, and things would blow up in the long term because they've taken all sorts of risks and they haven't set the proper foundation in place for long-term growth. That would be an example of the agency problem, but we have no such problem in this case. Why? Because the people who run the business on a day-to-day basis and the shareholders are one and the same. The 4 directors who run the company also own the company. So this is private company, not publicly listed, and that means that this business is not subjected to many of the public pressures that come with being a stock exchange listed business. They're not open to the same onerous regulations and inspection from banking analysts and regulators all the time that a publicly listed company might be. Having said that, though, there is a big negative that comes with being a private company, and that is you have fewer financing options. You're not able to tap into equity funding in the same way and go to shareholders to buy your shares if you want to make a big expansion. So this business is selling really in 3 ways. They have their own brand range of products. Then secondly, they provide contract manufacturing for other global vitamin and supplement brands. So that might be a way into other markets. And finally, they work with new and existing retailers, so it could be supermarkets and the like, that they're looking to develop their own private label ranges. So it might be Tesco they want to sell Tesco multivitamins, but really they're being made by this company, VitaMine. Now, we're told that the company has gained an excellent reputation over the years for a great quality of product and for excellent service. So you would think that with higher quality, it's quite likely that they're facing higher manufacturing costs, and that might also justify charging more premium prices. If they're noted and have a reputation for higher quality, they might have scope to charge a premium price, which you would have come across in your E1 studies when you consider the marketing mix. Now, something that would work against a company setting premium prices is the level of competition in the marketplace. And we'll see as we move through this pre-scene that this is an industry that is very competitive currently. This industry bears many of the hallmarks of a perfectly competitive industry. And that means that competition's likely to be quite cutthroat. There may be a move towards more consolidation as big players buy up smaller players, but that's going to take time to play out. So those competitive forces might constrain a company like VitaMine in setting premium prices, which would put pressure on their profit margins. So this is a growth industry, that's the good news, rapid growth over recent years, and this business, VitaMine, has taken full advantage of this rising tide. Their revenues increased 49% in the last year, and their profit before tax rose by 59%, so very robust growth figures there. However, there are challenges being presented that come with this growth. The company is having difficulty managing the business. Its staff, it's having difficulty ensuring that their staff are satisfied. There may be issues, for example, with high turnover rates, high staff turnover rates, etc. And there are indications that the company does not have the right infrastructure in place to support current rates of growth. So it may well be that this business has actually outgrown its systems and processes. The processes that it currently has in place may not be sufficient to ensure that staff are well utilised, that they're satisfied in their current jobs, etc. The company's strategy, the aim is to develop the product range while meeting environmental standards and providing the best quality products and service. So that's pretty much more of the same in terms of, that high quality offering and extending the product range perhaps. So you think of Ansoff's matrix, which you would have come across in your E1 studies, where a company can opt to go into new markets or serve the same markets, and whether it can go into new products or serve the same products. So this company seems to be expressing an interest to go into new products, that's product development, but to continue serving perhaps similar markets to the one it's currently serving. And this business, it seems, has grown organically to date. It has not relied on acquisitions, but there are one or two hints in the pre-seen document that there may be acquisition targets where they could vertically integrate, for example, a retailer, or maybe even they would want to vertically integrate a supplier. And actually, there's very little mention of suppliers in this pre-seen. The company has invested heavily over the years in new manufacturing equipment and research and development. And the reason that research and development has become so important is because there are skeptical claims being made in the press recently about the efficacy of vitamins and multivitamins in particular. So it's very, very important for a company like VitaMine to counter a lot of that negative press by trying to demonstrate with clinical tests that their products are effective and do what they say they do. Now, if this business is invested heavily in manufacturing equipment, we might expect to see high depreciation expenses, and that will be revealed when we look at the financial statements. So that would mean that profitability is affected, and the relevant accounting standard would be IAS 16, property, plant and equipment. And we'll talk about that a little bit more when we look at the financial statements. So even though the company has invested in manufacturing equipment and research and development, they've identified a need for future investment in central systems and processes. Now that's very important because that means that it is a likely exam issue where you are asked to comment on, for example, a potential investment in a new IT system, for example, that's more integrated, or new HR processes, investing in staff training, etc., hiring perhaps a HR director, which they don't have currently. And it's likely to mean as well that this is a business that is going to have to change the way it's doing things and ask its people to change the way they do things. And that can lead to resistance. One of the ways that you can face that resistance effectively would be through a model such as the one Lewin proposed, which you would have come across in E1, which relates to unfreezing the resistance, unfreezing undesirable behaviors, then moving people towards the desirable behavior, and then setting that in place. Unfreeze, move, and refreeze. So in the people section of this first page of the company background, we're told that this business has 323 staff, and 288 of these staff are working in manufacturing or research and development. So this is a business very much with a production orientation, it seems. And the fact that they have 323 staff means that they exceed the definition of what it means to be a small to medium-sized enterprise as is defined in the United Kingdom. So under 250 employees would mean a business is classified as small to medium-sized. And what's happening is that this business is just above that threshold. So it's becoming a big business. And there are, of course, advantages and challenges that come with being a bigger business. As a bigger company, for example, VitaMine could tap into economies of scale, and that means that they could have lower unit costs as they produce more and more and become better and better at producing. And they could tap into the learning curve as their employees become more and more adept at producing as they go along. They have the power, of course, to make big capital expenditures. It seems they have been doing that by purchasing new manufacturing equipment. They have more buyer power when it comes to negotiating with suppliers. So lots of advantages there with being a bigger company. But of course, as has been mentioned, there are big challenges that come with being a bigger company. And it seems that this business may have outgrown some of the old IT systems it has in place, some of the HR processes it has in place. So it kind of needs to catch up in those areas now. And the fact that so few employees are employed in the administrative areas of marketing and sales, finance, IT and HR, very important areas, we may well have an indication of where the problems are coming for when they talk about processes not being right and a need for investment in the infrastructure supporting the business. And that ties in with Porter's value chain, which I will discuss on the next page. But it may well be that these administrative areas are actually understaffed and that the people there are very stressed and they're not able to support the rest of the business adequately. Staff numbers, however, have grown rapidly. I wouldn't be surprised if most of the new employees have gone towards the manufacturing area and the research and development area, and that has presented significant challenges for the company, which we've been discussing. The 4 directors of the business then have a wide range of experience, we're told, in food and retail industries. They're young, they're highly enthusiastic, and they're very keen to ensure that the business grows in a profitable way. So that will be a key consideration. Any strategy that proposes needs to conform to that expectation. Profitable business development. It's no good if someone comes with a proposal that will grow revenues massively, but the margins wouldn't be particularly robust. It needs to be profitable growth, so costs kept down and the revenues to keep growing. The directors of the company, we're told, keep a close watch on company operations and they are the main decision makers. So presumably a lot of power resides with these 4 owner managers. It may well be that they are micromanaging the business. What you would want ideally is for the 4 directors, the 4 most senior people, to dedicate a lot of their time to strategic issues and that they would have a trusted team of senior managers and middle managers who would then keep an eye on company operations. So I think that might be flagging up a little bit of a problem there. And if the directors are too closely involved in the day-to-day running of tasks, then it may well explain how the business has kind of taken its eye off the ball in terms of, making the right investments in IT systems and the right processes. They're more strategic issues, and that might be part of the problem. There is a danger as well, perhaps, that what is spun here as a positive, the fact that they're young and highly enthusiastic, might, on the flip side, be interpreted as a little bit of naivety, a little bit of inexperience. Maybe they're overly enthusiastic to push the business towards profitable development, as they say there. And that might bring with it the kind of indiscipline that could lead to the company growing too quickly without the right infrastructure and solid base in place. So a couple of hints being provided here as to why the company's growth has presented challenges. And there's always the danger with the pursuit of profit that it is overemphasized in the short term, and it could lead to the concealment of big problems and errors being built in while the company pursues growth aggressively, and they would play out over the longer term. So a couple of things just to keep an eye on. So let's consider each of the directors' profiles here. And I want you to keep in mind good corporate governance as we move through this particular page. We want to think of the checks and balances on the power and influence of these 4 directors, whether they have internal controls in the form perhaps of an audit committee. Is there enough independent scrutiny? For example, there's no mention of non-executive directors here who would keep the directors honest and challenge them. And maybe as well whether there's a lack of experience in this team. So the top person at the business, the managing director, Suresh Patel, is responsible for the strategy of the business. He worked for a food manufacturing company before founding VitaMine in 2002. He is concerned that the business does not have the appropriate infrastructure in place, and he believes that needs to be taken care of to support future expansion. So at least Suresh has identified the problem. That is the first step on the road to solving it. As I said, this company is likely then to face change management issues. They may need to implement different IT systems, a more integrated IT system, for example, and that will present challenges, and they'll have to get people on board with those changes. Now, I want you to think as well of Porter's value chain, which you would have seen it during your E1 studies, and it seems that the areas of the value chain that need to be taken care of, firm infrastructure, human resources, the technology of the business, these are the support activities that Porter mentions in his value chain. The primary activities would relate to inbound and outbound logistics, operations, marketing and sales, and service. There are not really any suggestions that those areas are problematic. It's more the infrastructure supporting those primary activities. So let's work down through the main primary activities that each of these directors is taking care of. First one up is Melanie Tan, Sales and Marketing Director. And Melanie, we're told, worked for a health food retailing company before joining the other directors to form VitaMine in 2002. Her experience is in the retailing side of the industry, and that is invaluable. So her relationships with retailers is likely to be very valuable as VitaMine looks to sell to large supermarkets, pharmacies, etc., that would be stocking their supplements. And Melanie has the challenge of having to market to both businesses and end consumers. And there's a little bit more discussion on that in the sales and marketing section later in the pre-scene. We're told that this business, for example, predominantly markets to businesses, in other words, B2B, but does a little bit of B2C branding as well and marketing. And that is going to become more and more important as companies try to stand out from the crowd in a very, very competitive environment where brand power is going to be important. The second activity is covered by Juliet Go, the finance director, and this is a range of support activities listed here in accordance with Porter's value chain. And here is where some of the problems seem to reside. These areas are in need of a little bit of an update. So Juliet, finance director, SEMA qualified, and she is responsible not just for finance, but IT and HR as well. And that's a little bit of a red flag, because it may well be that Juliet is taking on too much responsibility there. It may well be worth employing a HR director separately and an IT director. And it's not surprising that some of the clues about the problem areas of the business reside in IT in terms of the systems and HR in terms of human resource management and processes in place there. Juliet, tough negotiator, we're told. She likes to keep a tight rein on the company's finances. Now that could put her on a collision course with some of the other directors, perhaps, should they want to make the big investments in the infrastructure of the business. So I would watch out for that. It may well be an exam scenario where Juliet opposes some big project where debt has been taken on. She might see it as excessively risky to invest in a new IT system, for example. And the third director and co-founder of the business, Victor Shang, very, very important person, the production director. That covers operations, which is a primary activity in Porter's value chain as well. But as well as production, Victor has responsibility for R&D. So again, questions need to be asked here about whether Victor is actually doing too much. And that will actually become more apparent when we look at the diagram on the next page. Victor is doing an awful lot. Victor is an engineer by training, and he is the main driver behind the company's growth. Now, that means it is vital he is not poached by a rival, a key person here. He needs to be looked after. And he is very keen to expand the company, and he's always looking around at potential new products. So this is a very likely exam issue. It's been mentioned twice already in the opening sections of this pre-scene. One idea would be for this business to go into sports supplements, which are ever popular, protein shakes, post-workout mixes, creatine, etc. And that would be, it seems, a natural way for the company to target another segment of this market and develop its products, for example. Let's take a look at the organization chart then. And I think this will make clearer some of the imbalances in this organization, and it flags up, I think, the problem areas that we've discussed briefly. So first of all, it's worth noting that this is a functional business structure. This is an organizational structure where similar activities are grouped together. There's a degree of specialization taking place, and the different functional areas then, they work kind of in silos and they report to someone higher up. Ultimately, they report to Suresh Patel, the managing director. And this is quite a suitable organizational structure for smaller organizations that work in relatively stable environments with fewer product offerings. So this business isn't overly big. It's just beyond the small to medium-sized enterprise threshold, as we said before. And they don't have a huge product offering. So it seems for the time being that this might be quite a suitable organizational structure. The pros of this particular organizational structure would relate to a degree of specialization, as I said, taking place. You have all of the production people working together in a silo, corresponding with one another, advising each other on best practices, etc. And in that way, they become better and better. There's a degree of standardization that comes from that collaborative effort, and efficiency that comes with getting better and better and sharing those best practices in your one functional area. The cons, though, relate to each of the functional areas being a little bit isolated, and there isn't a lot of communication between different functional areas. And it can also lead to a little bit of conflict occurring as, you know, the sales and marketing director fights it out for budget for her area, and Victor Shang is fighting it out for budget for his particular area, and that can lead to conflict occurring. Now, let's talk then about some of these imbalances that I have referred to. First of all, Victor Shang, key person. He's driving growth at this business. He's looking for new product areas to go into. Very, very important person. But 89% of the employees ultimately report into Victor Shang. And that is, I think, likely to be a big strain on Victor. He has the production area, but procurement as well, the warehouse area, and R&D. It might well be worth appointing a research and development director to take some of the weight off Victor, and maybe even spinning the procurement area off into its own function as well, or maybe combining it with the warehouse area and appointing a director there. We see also that Juliet, as the finance director, has those three areas under her. The finance area, which is going to be your department. You can see there you are listed as a finance officer. The IT area and the HR area. And what I would recommend perhaps is, again, making sure that there is a dedicated IT director and a dedicated HR director to alleviate some pressure from Juliet, and to ensure that those support areas are functioning more optimally and that the infrastructure in that way is taken care of. And that would alleviate some of the pressure that comes with growth and having the right infrastructure to support business growth that has been discussed already. So just 3 people, it seems, working in the finance area reporting into Juliet. So 4 if you consider Juliet as well, but she's somewhat stretched in terms of her functional responsibilities as they span IT and HR as well. And with such a low number of employees, perhaps in the finance area, there's always the danger that this area is overheating, that the people working in this area are taking on too much. There's a danger of oversights and errors occurring, particularly if the business is growing very rapidly. Think of your E1 studies and the finance function. You want the finance area to be reliable, to produce reports and information that's complete, that is timely, and we're less likely to witness those key characteristics if the finance department is understaffed. And there are indications later on as well that the finance area is doing a lot and that some of its processes and systems seem to be very outmoded perhaps. They've been the same since 2002. So I think, if Juliet was freed up from her responsibility over IT and HR, she could fully concentrate on finance, and that I wouldn't be surprised then to see the finance area become more efficient, and perhaps maybe hiring a few more people in the finance area would be a good idea as well. Just something else, you as the finance officer need to give advice that is always ethical. CIMA likes to test ethical dilemmas in all of its case study exams. They will usually come up in some variant or other, and you need to remember the CIMA Code of Ethics, which CIMA examiners love to see mentioned when there's an ethical dilemma. You need to ensure that you're demonstrating the core principles of objectivity, professional competence, confidentiality, professional behaviour, and integrity. So watch out for any requests, for example, to present figures in an overly optimistic light. You might be pressured from these very influential founders, to present figures in an optimistic light. And that would be something you would need to resist, and you'd need to lean on the CIMA Code of Ethics.